Okay. Hi, everybody. Thank you very much for joining us today and taking the time out of your busy schedule for what should prove to be a very informative and useful webinar. For those of you who don't know me, my name is Yossi Willig. I've been working in the tax and accounting industry for the last 12 years. I'm dually certified as a public accountant, CPA, and a financial planner, CFP. As the end of 2020 nears, we're finishing a year of unprecedented upheavals and significant volatility in personal and business incomes. This makes year-end tax planning all the more important and significant to your bottom line. This webinar focuses on a new tax planning opportunity that's especially relevant to residents of the state of New Jersey. And due to the nature of the opportunity, it may require almost immediate action on your part. As we proceed through the webinar, questions can be submitted via the question tool at the bottom of your Zoom window. You'll see it kind of looks like a speech bubble, and you can type questions in there. We'll be monitoring those questions, and they will be addressed at the end of the webinar to accommodate for other attendees' time constraints. For accountants who would like CPE, please contact us following the webinar, info@neuhauscpas.com. With that, let's move into the presentation. So today's topic is the New Jersey business alternative income tax. And, obviously, well, the big question is, what exactly, is that and how does it work? So what is the business alternative income tax and why is it such a great planning opportunity for everybody in our state? So we got to go back a couple of years. 2 years ago, the federal government passed what we call the TCJA, the Tax Cuts and Jobs Act, that created a $10,000 limitation on your ability to deduct state and local taxes. We call that the SALT limitation. And for a lot of people in our state, $10,000 is not really that much in terms of total state and local taxes. For many homeowners, their property taxes is more than $10,000 a year. So the value of the ability to take a state tax deduction, which used to be a given, right, was stripped away from most residents of the state of New Jersey. And as a result, many states have proposed different workarounds and trying to come up with ways to give you back your ability to take that deduction in excess of this $10,000. So what the BAIT is one of these workarounds, and we're going to go into detail exactly how that workaround works. Okay, so what a few states have come up with the concept of a pass-through entity tax. The concept is basic, and that is that instead of looking at individual income tax as a personal expense and therefore being subject to your itemized deduction limitations, which are twofold. Number one, only people that itemize deductions actually get itemized deductions. It's kind of obvious, but it needs to be said. And the other point is that there's this $10,000 cap. So to avoid both of those issues, what we're going to do is change the application of the income tax from being a personal expense, meaning that I'm going to pay the tax on my personal New Jersey tax return. Instead, I'm going to take this tax and turn it into an entity level tax. So now the tax is going to be a legitimate business expense, that is a tax that's levied at the business level. So we now have a business that makes a certain amount of profit, and New Jersey is going to levy a tax on the business itself. So forget about the owners of the business. The business itself is now going to pay a tax. Under that construct, the federal government will allow a deduction for the business's tax, just like they would allow any sort of business license and tax to be deducted from federal income. And it has nothing to do with your personal tax return. There's no itemized deductions. It's very simple. So that being said, many states have proposed this, and we'll see there's a few different models and exactly how the New Jersey one works. Okay, so New Jersey's BAIT. New Jersey created an optional, and that's an important word over here, pass-through entity tax, which means that you can decide if you want to do this business alternative income tax, or you don't have to if you don't want to. but we'll see that there's a lot of reasons why you might want to and what the advantages are. Okay, so we have this optional pass-through entity tax, which takes effect for this tax year 2020. It's the first time that this is available. Tax is called BAIT, Business Alternative Income Tax, and you may elect into this tax every year, okay, which means it's not a permanent election. If you elect for 2020 and you don't want it for 2021, you could change your mind. Every single year you get to make that election. And we'll talk about how you make the election and what the downsides might be. Okay, so most obvious question is who's eligible to do this, and how does it all work? So because this is a pass-through entity type of tax, a business has to be a pass-through entity. What is a pass-through entity? So a pass-through entity is any business, to make it easy to understand, if you're filing annually Form 1065 or Form 1120S, so you're either a partnership, you're a multi-member LLC, or you're an S corporation, you're a pass-through entity. If you're not filing one of those tax returns, you're not a pass-through entity. So is a trust a pass-through entity? No. Is a corporation a pass-through entity? No. Is a single member LLC a pass-through entity? No. So you got to be either a multiple member LLC, a partnership, or an S corporation. This may give people some thought about changing their entity structure, right? Because if somebody's a single member LLC just for ease of use, and they're kind of leaving the BAIT on the side, they may want to reconsider that. Okay, so how does it actually work? Now, different states have adopted different models. New Jersey's model is somewhat of a hybrid model, and let me explain what that means. So again, I told you the business is going to elect to be taxed on its income at a tax rate based on the total income of the entity, which means that this tax does not look at the owners of the business. It looks at the business as if it's a standalone entity. And it says, okay, the business made X amount of dollars. We don't care how many members there are, how many shareholders, doesn't matter. If the business made $100,000, the business pays taxes on $100,000. The fact that there are 10 partners and each one only gets $10,000, that doesn't matter to the BAIT. It's the business is paying taxes on its income based on the total income of the entity. Okay? Now, in a hybrid model, rather than, we'll talk about some other models, but in the hybrid model, the income is again reported by the individual shareholder on their personal tax return. Now, that may sound like double taxation, okay? But, and in a sense it is, meaning that the New Jersey entity is going to pay taxes on its own level to the state of New Jersey with this BAIT, and then the individual is going to pay taxes again on their individual tax return. However, you get a refundable tax credit on your personal tax return for every dollar of BAIT that's proportionate to you. So going back to that example, if you had $100,000 of income and the taxes were $5,000 and there were 10 partners, so we have $100,000 of income, meaning each one of those 10 members is getting $10,000 of income. $5,000 of tax means each one is getting a $500 tax credit. Now, for those of you who are familiar with New Jersey tax rates, you'll understand that the $500 tax credit is much more than the amount of tax that that person would ever owe on $10,000 of income. So that's why there's a key word here. It's a refundable tax credit, meaning that if you paid in more money on the BAIT than you would normally have paid as an individual taxpayer, you're going to be able to get a refund for that difference. So on your individual tax return, again, using the same numbers, let's imagine that your whole income is $10,000, so you're now in the 1.2% tax bracket, and you've now paid $500 instead of $120, you're going to get a $380 tax refund. Other states with the pass-through entity taxes have taken a different approach, a corporate model, which is that both the income, again, same concept, they're going to tax you on the business level, a tax across the whole entity's income. However, in those states, the income then disappears. It is not reported again on your individual tax return, which again, it could have upsides and it could have downsides, But mostly that's not a good thing, because using our previous example, if those people who only make $10,000 each were now having to pay 5% at the business level, they'd be paying, 3 times as much taxes, 4 times as much taxes as they should be paying. So probably wouldn't be a good idea for them if they're in a corporate model. Okay, so in that model, the income would not be distributed to the shareholders, and there's no corresponding tax credit. Okay, so what's the advantage of the hybrid model? So if the individual has a lower tax rate than the entity, the individual will receive a refund for that difference, right? Just like we just described, right? Each individual taxpayer is again reporting the income on their individual return, but they're getting a refundable tax credit for the total BAIT paid. Now, let's imagine a scenario which is very common in the state of New Jersey. You'll have 2 partnerships that you own. One of them has a profit and the other one has a loss. So now if I made a BAIT election on the profitable one, the one with the loss, whether you make the election or not, you're not going to be paying anything because you don't pay taxes on losses. So if I have entity A that's got income and entity B that's got a loss, and now I'm going to pay my BAIT on entity A, which has the income. So what happens when it gets to your actual tax return is that you're going to have a huge tax credit compared to the actual taxes that you might have had to pay. So using our previous example, let's imagine that each one of these individuals, right, they had $100,000 of income, they paid $5,000 of taxes. So each one of them got $10,000 of income and a $500 tax credit. Now, let's say they had a different entity that created a $50,000 loss. Now, each one of those individuals is only reporting $2,500 of income on their tax return, and they're still getting that same $500 tax credit. So we have $2,500 of income with a $500 tax credit. It's almost all going to be refundable at that point. So that raises the question of whether that refund would be taxable at the federal level, which right now it would seem that there's no, we talked about the tax benefit rule, and whether a tax refund is taxable is based on a simple analysis. If I receive the tax benefit for the taxes paid that generate the refund, we generally consider the refund to be taxable. So if, for example, if somebody paid $1,000 in state taxes and they took a $1,000 deduction on their federal tax return, and then they got a refund of those taxes, that refund would generally be taxable. But in this case, the BAIT tax is not paid at the individual level. It's a business entity tax, and it's not refundable. Nobody's getting a refund of that BAIT. The refund that you're getting at the state level is coming from a tax credit that New Jersey is giving to you, which is not at all obvious if that refund would be taxable. Currently, the IRS hasn't given guidance on this subject, but we'll see if we get better information. Okay, so those are the advantages of the hybrid model. Let's talk about some disadvantages. The hybrid model creates a disadvantage in a case where the individual might have a higher tax rate than the entity. Okay, so let's say somebody's got 3 partnerships, and each one, his portion or her portion of that income is $100,000 on each one. So if I were to stack those together, we're now at $300,000 of income. But each one is going to pay the BAIT at the lowest rate. So now we're going to end up with a mismatch where the New Jersey tax rate on their individual return is going to be higher than the BAIT rate on each of those 3 partnerships. So what's going to end up happening is that the individual is going to have an out-of-pocket liability on their personal tax return, even though with the BAIT we're trying to eliminate further taxation. But in the case of an individual with multiple entities, you may end up with a small tax liability. Further, if the individual has a higher tax rate than the entity, you're going to lose out on being able to maximize your BAIT because you're stuck with the lower rate of each entity rather than your higher rate. So let's say somebody's in the 8.97% New Jersey tax bracket, but each of their entities are only in the 5 or 6% brackets for BAIT, well, you're not going to be able to get that spread between the 6% and the 8.97%. You're still going to be stuck with your SALT limitation. Okay, let's go through an example so you can see exactly how this plays out. So we have case study number one. We have a multiple member LLC. We'll call it Lakewood Property Management LLC. 3 members each own 1/3 of the LLC, and all the income is New Jersey sourced. The net income of this entity is $600,000. So for BAIT purposes, we have an entity that makes $600,000. So we have our total NJBAIT income, $600,000, and the taxes are calculated using the table below. So we've got here, you can see the tax rate. The first $250,000 is taxed at 5.675%. Any amounts above $250,000 up to $1 million are taxed at 6.52%. The amount above $1 million, not exceeding $5 million, is 9.12%, and then it goes to 10.9%. So in this case, we take our 600,000 minus 250, right, which is going to be the part that's subject to the 6.52, plus 14,187.50, which is the 250 at the 5.675, and that gives you a total tax of $37,008. Okay, now those taxes of $37,008 are taken as an expense on the federal tax return. So now instead of paying taxes on $600,000, we're now paying taxes on $562,992. Now remember, there are 3 partners here. So each member is going to get taxable income of $187,664 instead of $200,000, which equates to a $12,336 reduction of income for each member, right? Which we think for most people would be worth at least $2,700 each, which when you look at the whole partnership is worth about $8,100. So that's a nice savings for zero out of pocket, because you're going to pay the taxes to New Jersey anyway. So by making this BAIT election, you've simply transferred where you pay the taxes. Instead of paying them on your 1040, your NJ 1040, you're now paying them with your 1065 filing. But essentially, you're paying the same dollars, and you're putting an extra $8,000 in your pocket. Good deal. Okay. Let's go to another case study. We have an S Corp. Okay, in this S Corp, we're using a single shareholder, which is going to create an even larger tax savings. So we have a shareholder owning 100% of an S Corp. There's $840,000 of income, which is New Jersey sourced. Okay. Now I use that number just so that you can kind of see the how this plays out. But it's got the same numbers. It will help you follow a little better. So you have $840,000 of income, which is New Jersey sourced, and we have net income of $600,000. Now, how did we get from our 840 to our 600? And the answer is we took a salary to that shareholder of $240,000. Why did we take a $240,000 salary? That has to do with QBI. Okay, if you remember, we have a 20% pass-through entity deduction at the federal level, which is subject to a limitation. And that limitation is that you can only take your 20% deduction to the extent that you have payroll, which is double the amount of the deduction. Okay, that's a lot of numbers to remember, but just to stay focused over here, if I had $840,000 of income and a $240,000 salary, that leaves me with $600,000 of income, $120,000 being the QBI deduction at 20%, which equals half of the salary. So we've now optimized, right? We have a $240,000 salary, we have a $600,000 income, right? So we've maximized our QBI deduction at $120,000, and now we have to calculate our BAIT. Now, I put a note here that indicates that QBI deduction effectively ends up being around a 10% tax benefit when we're trying to weight it against, should we have more payroll, should we have more income? And the BAIT at this level is around 6.5%. So we're still better off optimizing for QBI than we are optimizing for BAIT. Okay, so we're using the same numbers because we have the same BAIT income at $600,000. So same 37,008 that we had in the previous example. But now it's one shareholder. So this shareholder now is going to get the full $37,000 deduction on their tax return, which results in reduced income of $37,000. This shareholder being at a much higher income level than those 1/3 members in the previous example, their tax savings is close to $13,000. Pretty impressive. Now, just to dive in a drop deeper here, once we're talking about the QBI and how it mixes with the BAIT, there's a complex calculation that's necessary to really optimize that, because for those of you who are familiar with how the QBI works, if I take a BAIT deduction, that's going to reduce the available income for QBI, which in turn should reduce the amount of payroll that I need to optimize it. So you got to run somewhat of a complex 3-part calculation, but we've calculated that instead of 240 at 229, 250. So that would give you the perfect lineup where you get your most QBI and the most BAIT altogether. So if I took the 229, 250 for payroll instead of my 240, your BAIT income goes up to 610, 750. Your BAIT deduction goes up from the 37,008 to 37,708. The federal income is 573, but you're getting a bigger QBI deduction. So altogether, your total deduction ends up being $152,000 between the QBI and the BAIT, worth over 50 grand. Whereas had you stuck with the original 240, you would only have deductions of 149. So you're leaving around $2,700 of deductions unclaimed, and you would be paying payroll taxes on an extra $10,000. So, when we get down to it, is this huge? It's not huge, but it's probably worth a few minutes of somebody's time to figure out what the optimal arrangement is. Okay, now let's get into how do you actually make this election. So we have a new New Jersey Division of Taxation website, right? If you search for NJ BAIT tax, it should come up. And we have a new section on the website just devoted to this new tax. There's an online form that you complete indicating that you're claiming the election for the current tax year. Right now, there's only one tax year you can make that election for, so you can't go wrong. Once we get into next year, it's already conceivable that you could make the election for 2021 and 2020, so just be careful if you're doing it next year. Okay, when does this election actually have to be made? It's got to be made by March 15th of the year following the relevant tax year. It means for 2020, to make an election that you want to do the BAIT, you have to lock in by March 15th of 2021. And that's the way it's going to be going forward. So for 2021, you'll have to make that election by March 15th of 2022. Okay, now, important distinction here. This is the election, not the payments. Okay, we're going to talk about when you need to make those payments in order to get the tax deduction. But in terms of the elections must be made by March 15th. If you miss that date, you're kind of out of luck, because there's no extension, and based on current guidance, there's no retroactive election either. Okay, now let's talk about the payments. So you made the election, you want to do the BAIT, I want to get this federal tax deduction. When do I have to make my BAIT payment in order to get my tax deduction? So here it really matters if you're a cash basis entity or I'm an accrual entity. What does that mean? So a cash basis entity means that the entity records its income and expenses when they're actually received or paid out. So if I'm a cash basis entity and I want to take a tax deduction for a payment, I got to make that payment before December 31st. Meaning, even though I don't have to make my election until March 15th, but if I want to take that BAIT deduction this year, I got to make the payment this year. let's say you don't make the payment this year, you'll get the deduction next year. So if somebody makes a BAIT election for 2020 and makes the payments in March, that will work, but their deduction is going to be on their 2021 tax return. So you might want to do that if you feel like your 2021 income is going to be bigger than your 2020 income. But if you feel that your 2020 income is the better option, then make the payment before December 31st. An accrual basis entity is different. Accrual basis means that we figure out what are the relevant taxes that are due for this entity. So if the entity is ultimately going to make that election and we can ascertain what the tax liability will be, which we should be able to do, we can accrue the taxes, meaning we don't actually have to pay those taxes to deduct them. As long as we know we're going to do that, you should be able to take the full deduction for whatever BAIT is relevant just by making the election, and you'll make the payments whenever they're due. Okay, now, important again, the timing of your federal deduction has nothing to do with your New Jersey due date for the taxes. Okay, so whether I'm an accrual or in a cash basis, right, your federal deduction doesn't have anything to do with your due date for the taxes. So all entities that make the BAIT election must pay their taxes by March 15th of the following year, or it will be subject to interest and penalties. Okay, now, usually, whenever there's a tax liability, there's an estimated tax requirement, meaning that the taxes have to be paid quarterly. BAIT is no different. It's got interestingly enough, New Jersey followed the individual quarterlies. So it's April, June, September, January are the 4 quarterlies for the BAIT. Now, that being said, because 2020 is the first year, there are no estimated requirements for 2020. Moving forward, though, we will have estimated tax requirements. If you anticipate doing the BAIT for 2021, there'll be another payment due in April. Now, okay, estimated tax payments, though, again, have nothing to do with your tax deduction. They just simply avoid interest and penalties. So just to recap, if I'm a cash basis entity and I want to take a deduction this year, I need to make my payment by December 31st. I need to make my election by March 15th. If I'm an accrual basis entity, I need to make my election by March 15th, and I need to make my payments by March 15th. If I don't make those payments by March 15th, I'm going to be subject to interest and penalties. Going forward, you'll need to make quarterly payments, otherwise you'll be subject to a certain amount of interest. Okay. Now, like I said, make a payment now. So if you're a cash basis entity and you want to take this deduction this year, you got to make that payment before the end of the year. How do you actually do that? So there's like I said, the same website where you're going to make that election, there's a estimated tax payment form, which is where you're going to make that payment, because right now the payments are not final. Until March 15th, we're not going to actually have the forms to make a final payment. So we're going to make an estimated tax payment, right, before the end of the year. That would be for a cash basis entity. If you're an accrual basis entity, you can wait until March 15th to make your first payment. Okay. Now, getting a lot of questions of, I don't know exactly what my income is going to be. So how much payment should I make before the end of the year? So if I'm a cash basis entity, you'll get a federal deduction for the full amount of your estimated tax payment, even if you pay too much. So most people would probably want to err on the side of overpaying rather than underpaying, just because the worst thing that will happen is you'll get a refund, and you'll still get your tax deduction this year. A refund of the BAIT itself would be taxable at the entity level, but that's all that's doing is shifting income from this year into next year. Now, you can't go crazy and just pay as much money as you want in estimated BAIT, right? We get into legal problems there, but a reasonable liability can be paid. An accrual basis entity, on the other hand, has no real motivation for overpaying, because the actual deduction will be limited to whatever the actual taxes are. So for an accrual basis entity, you should probably wait a little bit, figure out what your real taxes are going to be, and then pay. Again, any overpayments that you make on your BAIT could be claimed as a refund on the BAIT tax return, or you could carry it forward just like any other refund to cover your next year's BAIT. Okay. Again, if you're a cash basis entity, that overpayment would be taxable as income in the next tax year. If you're an accrual basis entity, there wouldn't be any taxability of the overpayment because you wouldn't get a tax reduction in the first place. Okay. Now, we're getting a lot of questions about, what happens if I have a whole bunch of entities and I want to do the BAIT? How does that kind of shake out? So, unfortunately, New Jersey hasn't really given us the best guidance. So, I'm going to give you what they have issued, but there's still more questions than there are answers in this regard. So, other states have allowed a pool. So, for example, in Connecticut's past due entity model, they actually have a special form where you list all the different entities that you're part of, and you pool them together, and then you pay your entity level tax. New Jersey doesn't have that. But it would seem, under the current guidance, that it might be possible to move yourself into a higher bracket for BAIT by having a tiered partnership structure where the holding company is picking up income from a whole bunch of different entities, and now all those entity incomes are going to be pooled together at the holding company level, which should create a higher BAIT. But again, the frequently asked questions that New Jersey has posted are not so clear on exactly how this works. So we're going to have to, this needs to be ironed out. Now, we talked about earlier, New Jersey doesn't have a passive activity loss rule. So what this means is that many people who have, they might have small real estate holdings, they partner in some sort of real estate venture, they might have a loss, which for federal purposes is disallowed under the passive activity loss rules, but for New Jersey purposes, it's allowed. So you're going to end up with a situation where your active partnership is creating income and your passive partnership is creating losses. And as we said earlier, because of the hybrid model, both incomes are going to come down to your personal tax return and offset each other. You're going to have your income, you're going to have your loss, and you're going to end up getting a nice refund on your individual tax return. And as I discussed earlier, it would seem that those should be tax exempt because the refund is not coming from the payment of a tax that was refundable. Rather, it's coming from a refundable tax credit. Okay. So who should and who shouldn't do the BAIT? What's the advantage and what's the disadvantage? So why would I want to do the BAIT? Obviously, you're going to take advantage of reduced federal income. You'll save on your federal income taxes. Further, you could even bring your federal income below certain thresholds. So, for example, people who are on the borderline of QBI issues or other phase outs that happen, whether it's the capital gain threshold for popping from 15 to 20%, or different itemized deduction phase out. So there could be a huge advantage in addition to the savings where you're bringing your federal income down. For an active member in a partnership, there's a third incentive, which is you're going to reduce your Medicare, your Social Security earnings. So the BAIT actually is being a real tax deduction on your federal active partnership is going to bring down your income for all tax purposes. Okay. Another advantage is sometimes you've got partners that, at the end of the year, they're faced with a big state level tax bill. So as an alternative to making estimated tax payments, having the partnership pay BAIT on behalf of its members just takes one more bill off of each individual partner's head. Okay, now, why wouldn't you want to do it? So first of all, if you've got a non-resident member, okay? So let's say I have a partnership that's got one New York member, one New Jersey member. Now things get really complicated because the BAIT would still be assessed on the entire income, regardless of where the member lives or where their tax residence might be. And even if the member is a nonprofit or tax exempt entity, the BAIT doesn't care, right? Whoever the members are, you got to pay taxes on the whole thing. So we end up with a situation where your New York member has to pay, the partnership has to pay taxes twice for that New York member. First, BAIT, and second, because he's a non-resident member, you've got a non-resident withholding requirement under your CBT 1065. So we're now paying twice tax for the same person. Now, that's not so bad necessarily, because again, so it just means they'll get some refunds on their New Jersey tax return. Where it gets unclear though, is would New York actually give you a credit for taxes paid to another state on the BAIT portion of that payment? So just to walk through that. Again, imagine I have a partnership, 2 members, one's a New York member, one's a New Jersey member, and the partnership makes $200,000. Now, the partnership is now going to be subject to 2 taxes for that New York member's $100,000. One tax being the BAIT, right, which would be, let's say, $5,000 for that New York member, just to round it. And the partnership would pay another $5,000, let's say, for the New York State non-resident tax on Form CBT 1065. Now, when this individual files their New Jersey tax return, their actual tax might be somewhere in between. It might be $6,500, let's say. So they pay $6,500, but they're not actually paying anything because they've gotten a $5,000 tax credit and a $5,000 non-resident withholding. So they're actually going to walk away with a $3,500 refund. But the question is, coming back to New York State, will New York State allow that credit that they received from the BAIT to be a credit against their New York State taxes? Or will New York State say, hey, you got a refundable tax credit on your New Jersey tax return? That's got nothing to do with us. So you only paid $5,000 to New Jersey as far as we're concerned, and we're going to tax you on that other $1,500, which essentially means that you're going to pay taxes twice on the same income. So until that's resolved, if you're a non-resident member, you're really going to want to look at your state and see, does my state offer this tax credit against the BAIT credit? And so far, not that many states have weighed in on this. So that's a big disadvantage for a non-resident. Okay, what if I'm a tax exempt member? So let's say we have a nonprofit that owns a piece of a partnership, or I have a retirement plan that owns a piece of a partnership. In that case, the BAIT still has to be paid for the tax exempt entity, as silly as that might seem. And New Jersey even set up a system to file for a refund. So basically, the tax exempt entity doesn't usually file anything, but they're going to have to file a special tax return to claim a refund for the BAIT. Why they can't just simplify this and say, hey, cut out the refund and reduce the tax, I don't know. But that's definitely an open issue. Now, a third consideration here, I called up one of our local mortgage companies, FM Home Loans, and Ari Cooper-Smith was kind enough to give me some of his time to discuss how the BAIT would affect your income for mortgage eligibility. So if I have, let's say I have a certain amount of income and I need that to hit my ratios for, debt to income, and I take a BAIT deduction, that's probably going to reduce my debt to income. It's going to adversely affect my debt to income ratios. So you got to, if you're in the process of underwriting a mortgage or going for financing, you should definitely consider that before making the BAIT election. Okay, other states. So just to wrap this a little bit better, there are some other states that have a similar concept to BAIT. We have a Connecticut level mandatory pass-through entity tax. So Connecticut has taken a more, they're attacking this more on a that's it. Everybody's going to have to do their pass-through entity tax, and it's not optional. All Connecticut partnerships must not pay for all members. Interestingly enough, New Jersey has indicated that if you pay a Connecticut pass-through entity tax, you will get a credit on your personal tax return for the PTE credit that Connecticut gives you, which is nice. So if somebody here is a member in a Connecticut partnership that's paying pass-through entity tax, you're at least you don't have a double taxation issue. So you're paying Connecticut the PTE level tax, you're getting a credit on your Connecticut tax return for that PTE tax, and you'll further get a credit on your New Jersey tax return as if you paid taxes to Connecticut. other states, so we have Louisiana, Oklahoma, and Wisconsin, which have adopted optional pass-through entity level taxes, but with the corporate model. So that means that the income is taxed only at the entity level, and it's eliminated from your personal tax return. So again, that has upside and downside, right? If somebody's got a income, one partnership with income and one partnership with losses, this would be a bad thing because you're now paying taxes on the income without getting any benefit for the losses. So you probably wouldn't want to do that in that type of situation. And there's no pass-through, which means you're paying at whatever rate is, the pass-through entity tax is being paid at, regardless of whether you're in a higher bracket, lower bracket. So obviously, if you were in a higher bracket, that would be really good. But most of these states have set the pass-through entity level tax at the highest bracket. So not too much to be taken advantage of over there. And the only state that's really similar to New Jersey on this is Rhode Island, which has adopted a system that's almost exactly the same as BAIT, but they kind of made it simpler. There's only one tax rate, and that is 5.99% across the board, which again is Rhode Island's highest tax rate anyway. So, in that sense, they're kind of, just putting everybody at the top level, which, if New Jersey would do that, it would probably end up being advantageous, but New Jersey has such a highest level that I think it might scare people off. Okay, now there's still some uncertainty about this BAIT, so we do want to, clarify which points we're not clear on. Okay, so federal uncertainty. So until recently, it was unclear if the IRS would challenge the BAIT, which is probably why you didn't hear too much about it until recently. On November 9th, right, the IRS finally issued a notice 2020-75, which indicates that the IRS will accept this type of workaround, right? So we're not worried now that the IRS is going to come back and say, as far as we're concerned, the BAIT is just an illegitimate way of trying to circumvent the SALT cap, and we're going to nail you for it anyway. The IRS basically said, we're not attacking this, okay? What still remains unclear is what we talked about earlier, if the state tax refund arising from the BAIT tax credit would be taxable, right? And because right now we only have this Connecticut, New Jersey, and Rhode Island, they're the only states that have this tax credit. I don't know how soon we're going to actually see anything from the IRS on that subject, but again, I think that the simple understanding would be that it would not be taxable. Okay, we still have some New Jersey uncertainty. So will the BAIT aggregate all income for a tiered partnership, right? We talked about that as a possible strategy if it does. So if I had multiple partnerships and they're all in low BAIT tax tiers, and I wanted to get them all together into one holding company so I could be at a higher BAIT tax tier, which is more reflective of my individual tax rate, right? It would seem like you could, but again, the instructions that they've issued so far are kind of vague. Second of all, will an S-Corp's BAIT income be calculated inclusive of lower tier entities? So a similar question, if I have an S-Corp that owns an interest in a partnership, would that interest in the partnership be included to calculate the S-Corp's income for BAIT purposes? Here, the answer is almost certainly yes, because the way the S-Corp tax return is structured in New Jersey is it takes the tiered partnership income as a line item, whereas on the 1065, the two incomes are really kept separate. So it would be easier for there not to be a unified situation on the partnership than on the S-Corp. And the third question, which is relevant to a lot of our clients, is will the S-Corp's BAIT income be calculated before the allowable charitable deduction or after? So if I had an S-Corp, right, that made $500,000, but the shareholder gave $50,000 to charity, would I be paying BAIT on $450, or would I be paying it on $500? That's kind of an important question that we're not really 100% on. The way the instructions sound like right now, it would be after the charity, because the instructions seem to indicate that it's the K1 numbers added together, and the K1 numbers are net of charity, but again, we're still waiting for some clarity on these issues. Okay, so now that's the basics of this. We're gonna open the floor to questions. You can ask the questions now using your question tool, or if you want to call us later or send an email to info@neuhauscpas.com. Okay, so let's see what we got here. Okay, so question. If a partner receives a guaranteed payment from a partnership, is that income covered by the BAIT? Okay. Now, fair question. Okay. Now, just to put that into perspective, a guaranteed payment on the federal level, right, is actually an expense to the partnership, but it's reported on the individual's K-1. Now, but for New Jersey purposes, the guaranteed payment is part of the K-1 income. So again, from the way we're understanding it, probably the guaranteed payment would be includable for BAIT purposes. Okay, so questions about tiered partnerships, right? Again, like I said, we're still not 100% clear on what happens in the case of a tiered partnership. The guidance that we've been given so far is that if a tier, let's say a lower tier, makes a BAIT election, it would seem that there is going to be a mechanism that will allow the upper tier to at least benefit from the BAIT that was paid on its behalf. But the current FAQ says that benefit is going to be on the CBT 1065. As far as I'm concerned, that really doesn't make a whole lot of sense, because the CBT 1065 is a withholding return and really has nothing to do with the BAIT. So why New Jersey would put the benefit of the lower tier's BAIT payment onto the upper tier's non-resident withholding return, that's, to me, that's just a mistake in the FAQ, but we'll see how this actually plays out. In terms of non-resident partners, we touched on that point. When you have a non-resident partner, that's something the BAIT is very clear about. You will still have to pay the estimated tax for that non-resident partner. So you're going to end up with two taxes. If you make a BAIT election with non-resident members, you're going to have the BAIT, and you're going to have withholding for the non-resident member. Now, again, like I said, in some states that's going to be a problem, because the state may not give a credit for the credit that you receive on your New Jersey non-resident return. Okay, question about, is the BAIT a deduction for New Jersey purposes? And the answer is no. So again, imagine I have a partnership, right? We ran through the numbers. You had a $600,000 of income, and you got a $37,000 BAIT deduction. That deduction is exclusively for your federal taxes. At the state level, you're still paying taxes on $600,000. So the BAIT is just like any other state level tax that's not deductible for the state purpose. Okay, one thing to keep in mind here, and this has come up a number of times in our planning, is sometimes for federal purposes, we may have like bonus depreciation or something that's bringing the income down a lot for federal purposes. But at the state level, the income is much higher. So your BAIT is calculated on your state level income, but creates a federal tax deduction. So just keeping that in mind can sometimes be very confusing. So again, my BAIT is based on the state income, but it's only a federal tax deduction, not a state tax deduction. Okay. Any other questions here? Okay, so Okay, so there seems to be a little bit of a confusion about the taxability of the refunds. I just want to clarify that. There's two different refunds that we talked about. We talked about the refund of the BAIT itself. So if somebody were to make an estimated tax payment before the end of the year, right? So let's say they made an estimated tax payment for BAIT of $20,000. And then it turned out that their BAIT was only $18,000. So they're going to get a refund of BAIT on their BAIT tax return of $2,000. That refund, if they're a cash basis entity, would certainly be taxable at the federal level. The refund that we said is probably not going to be taxable refers to the individual level refund. So again, I have this individual who received the BAIT credit on their New Jersey tax return, but their actual individual tax rates were less than the tax rate imposed by the BAIT, which could either be because they had various deductions that were available for individuals, or because their overall, they had losses from other entities, whatever the case might be, their individual tax rate ended up being less than the credit allowed. In that case, we think that the refund would probably not be taxable because it's not a refund arising from a tax that was deducted and then repaid to you. It's a refund that's arising from a state tax credit. Okay, I think that's all the questions we have right now. Thank you everybody for joining us. And again, if you have questions, you could reach out to us or to your regular accountant. And thank you again.